Good morning and welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, can I build a house with a self-directed IRA? So we're going to cover this topic, and this is also your chance to ask questions regarding today's topic or any other aspect regarding self-directed IRAs and even solo 401k plans. We're well versed on both the solo 401k plan and the self-directed IRA regulations. So I don't see any questions at the moment. We'll go ahead and get started, and we'll monitor the chat for any questions. So make sure to chat them over so that we can get to them all. So let's get started. So we oftentimes get the question, can I build a house with my self-directed IRA? The short answer is yes. You can build a house using a self-directed IRA. But there are strict IRS rules you must follow. If it's structured properly, your IRA can purchase land, fund the construction of a home, and hold the property as tax deferred if inside a traditional IRA, or potentially tax-free inside a Roth IRA. So whether you make the investment through the traditional IRA or the Roth IRA depends on whether or not it's going to be tax shelter or tax-free. So it's important to understand, however, if you violate the prohibited transaction rules, the entire IRA could become taxable. So we're going to break this down clearly. Okay, what is a self-directed IRA? Well, a self-directed IRA is simply an IRA that allows you to invest in alternative investments, aka assets such as real estate, private loans, private equity, precious metals, tax lien, even cryptocurrency. Therefore, the rules that apply to a self-directed IRA come from the Internal Revenue Code Section 4975, which governs prohibited transactions. So as far as the question, can an IRA build a house? Again, yes, but the structure must look like the following. The IRA purchases the land. So you use funds from the IRA to purchase the land. Therefore, title to that property is taken in the, title is taken in the name of the self-directed IRA custodian for the benefit of the IRA. Now, the IRA is going to pay all of the construction costs when you're developing that land. The completed home is going to be owned by the self-directed IRA. So the property is held for investment purposes, typically for rental purposes or long-term rental. An important rule to understand is that the house cannot be built on land you already personally own. That's very important. So if you have land that you own personally, or your business owns personally, or this qualified party owns personally, or through their business, that land would not qualify. Because again, the house cannot be built on land owned by you or a disqualified party. So if you already own the land and your IRA built a home on it, that would be considered a prohibited transaction. Why? Because your IRA would be improving your personal property, and that's disallowed. Instead, the IRA must purchase both the land and fund the construction of that house. And again, title must be vested in the name of the self-directed IRA trust company for the benefit of your IRA. Let's talk more about prohibited transaction regulations, because since that's very important, especially in the context of investing in IRA and alternative investments such as real estate. So the IRS regulations, specifically the IRS code, does not allow you to personally benefit from your IRA owned property. Therefore, you cannot live in the house, you cannot vacation in it, you cannot allow your children or parents to rent it or live in it. You cannot personally perform construction work, neither can disqualified members, parties that is, such as your parents, children, and so forth. Expenses must be paid from the self-directed IRA. So you personally cannot pay expenses and reimburse yourself later. That's still considered disallowed. You cannot use the house as collateral for a personal loan. So if you're trying to obtain a personal loan from a bank, for example, you cannot use that property, aka the house owned by your self-directed IRA, as collateral for that loan. That's prohibited. In short, violating these rules can disqualify the entire self-directed IRA. Let's talk about disqualified parties. And then we'll take a look at a question that that I see here in the live chat. So we'll get to that question in a moment. Let's cover this slide here first. So who are disqualified parties? Well, disqualified persons include you as the IRA taxpayer, aka participant, owner, your spouse, your parents and grandparents, your children, essentially any entity you control. And of course, certain fiduciaries or advisors. You also cannot sell property to your self-directed IRA. You cannot buy property from your self-directed IRA or provide services to it. That's disallowed. For example, you cannot act as a general contractor. In short, you cannot even swing a hammer or put a fresh coat of paint on the house. So you also cannot front construction costs. In short, all transactions must be handled strictly through the self-directed IRA. Okay, before we start talking about how expenses and income must flow, let's take a look at this question here. Well, my 401k plan explicitly permit income and IRA rollovers in its plan document. I'm wanting to fund a 401k account by a Schwab traditional IRA. Yes, it's actually a statutory regulation that you can transfer IRAs, as long as it's not a Roth IRA, as well as former employer plans to a solo 401k plan. It's the financial institution that puts restrictions. It's not the actual plan document that places restrictions, because that's a statutory regulation. So, for example, there are some institutions out there that do not allow for income and transfers of IRAs into solo 401k plans. So that's the institution's restriction. It's not the IRS statutory regulations restriction. So the answer is yes, you will be able to transfer IRAs to the solo 401k plan because we don't put any restrictions on that. Okay, good questions. So Let's talk about how expenses and income must flow. Again, we're talking about how the question we're trying to answer today is, can I build a house with a self-directed IRA? So when building a house inside a self-directed IRA, all expenses must be paid by that self-directed IRA. So the land purchase, permits, materials, contractors, utilities, property taxes, insurance, and so forth. Those are all expenses in connection with that land in that house that will ultimately be owned by that self-directed IRA. All income must also be returned to that self-directed IRA. So rental income, proceeds from the sale of the property, or even proceeds from the sale of the land if you later decide that you do not want to develop that land after all. So if structured correctly, in a traditional IRA, the growth remains tax deferred. In a Roth IRA, growth may be completely tax free if qualified distribution rules are met. Many account holders will utilize their self-directed Roth IRA to invest in real estate, including purchasing land and developing that land, which is owned by the self-directed Roth IRA, and developing the house with self-directed Roth IRA funds. That way it'll all grow tax-free. So this leads to the question, can you eventually take the house out of the self-directed IRA? Well, the answer is yes, through what's called an in-kind IRA distribution. So let's talk about what an in-kind IRA distribution is. Let's define that. So an in-kind distribution means the IRA distributes the actual property to you instead of selling it. So yes, you can take a distribution from an IRA in the form of an asset as opposed to taking it in the form of cash. Let's talk about some important requirements, however. So before you can distribute that property from that self-directed IRA through an in-kind distribution, the property must be valued at fair market value. So a qualified appraisal is required from a third party. And then the fair market value becomes the taxable amount. So if it's a traditional IRA, then it's going to be fully taxable. If it's distributed from a self-directed Roth IRA, depending on whether it's a qualified versus non-qualified distribution, it won't be taxable. Let's talk about the tax consequences. So if you make the in-kind distribution of that house from a self-directed traditional IRA, then the fair market value is treated as ordinary income. So that means that whatever the fair market value is resulting from that appraisal, that's the amount that's going to be subject to taxes. So federal income taxes will apply. Now, regarding whether or not state taxes apply, it depends on your state of residence. Not all states will assess state taxes to IRAs. Also, if you're under age 59 and a half, a 10% early distribution penalty will apply. So it's best to wait until you're age 59 and a half or older if you decide to consider making a distribution of that house from that self-directed IRA. Now, if distributed from a Roth IRA as opposed to a traditional IRA, then as long as you've had that Roth IRA for at least 5 years, or even any other Roth IRA, and you are age 59 and a half or older, then that's going to be considered a qualified distribution. which means that no federal income tax will apply. There won't be a 10% penalty. Also, state taxes would not apply. So this is why, from a planning perspective, building inside a self-directed IRA, a self-directed Roth IRA, can be significantly more tax efficient versus a self-directed traditional IRA. It has to do with taxes, just like all retirement accounts. You need to consider taxes. So some strategic planning considerations. If your goal is ultimately to personally own the home, it may be more advantageous to use Roth IRA funds to purchase the land, use Roth IRA funds to build a house, allow appreciation to occur inside the Roth, and then distribute the property after age 59 and a half. If done correctly, the entire appreciation could be tax-free. In contrast, distributions from a traditional IRA could trigger a large taxable event based on the full fair market value at the time of the distribution. Let's talk about some key takeaways and as well as key risks to watch out for. So running out of IRA liquidity mid-construction. The last thing you want is to end up purchasing land with that IRA with the intent to build a house, and then later on, you run out of IRA funds to finish building that house. Because in order to continue to build that house, you would need to transfer other IRAs or former employer plans to that IRA so that you have more funds available to continue building that property. Other key risks to watch out for is accidentally paying an expense personally. So again, IRA expenses have to be paid with IRA funds, not personal funds. You also cannot perform any sweat equity labor. You want to make sure that the property is titled correctly in the name of the self-directed IRA custodian for the benefit of your IRA. And also make sure you understand the appraisal requirements. Because if you want to make a distribution of that property from that self-directed IRA, it has to be done at fair market value. So in short, one mistake can disqualify the entire IRA. So from a final thoughts perspective, yes, you can build a house with the self-directed IRA, but the IRA must own the land. The IRA must fund all construction. You can now personally benefit. All income and expenses must flow through that self-directed IRA. And in-kind distribution of that property from that self-directed IRA requires an appraisal and may trigger taxes, depending on whether the distribution is from a traditional IRA or a Roth IRA. And in the case of a Roth IRA, whether it's a qualified versus non-qualified Roth IRA distribution. So from a long-term wealth building standpoint, using Roth IRA for real estate development can be one of the most powerful strategies available if structured correctly. So before proceeding, it is critical to make sure you consult with your tax advisor to ensure all compliance with the IRS prohibited transaction rules. Okay, let's see if we have some questions here. Let's see if we have a. Here's a question. Oops, get back here. Is there a waiting period before my 401k can accept new deposits? No. As soon as your solo 401k has been opened and the holding accounts, aka bank and or brokerage accounts have been opened, You can make contributions right away based on your earned income from self-employment activity. You can also transfer IRAs and former employer plans to the solo 401k plan. It's also important to understand that you can transfer an unlimited amount of IRA and former employer plans to the solo 401k, and they do not count towards your annual contribution limit. So annual contribution limits are different than income and transfers from IRAs and former employer plans to the solo 401k. Another follow-up question here. After I fund the 401k plan, is there a waiting period before I can process a solo 401k participant loan? No, there's no waiting period either. So once those funds have been transferred to the solo 401k and those funds have cleared, because keep in mind, anytime you deposit funds into any type of bank account or brokerage account, the financial institution will put a 5-day holding period on those funds to make sure that those funds clear. Once they clear, you can process the solo 401k participant loan, and a solo 401k plan for my solo 401k financial does allow for solo 401k participant loans where you can borrow 50% of your solo 401k balance, not to exceed $50,000. Let's see if I can share a link from our website on that for you here. Give me a moment here while I try to dig that up here. So let me share our FAQ page on our website regarding loans. But yes, you'll be able to borrow as soon as those funds clear. When you make payments for that loan, they're going to flow directly back to the solo 401k holding account. Payments are made monthly or quarterly. They consist of principal and interest. Also, there's no credit check for the loan because when you process the loan, you're borrowing from your own 401k. Again, the maximum you can borrow is 50% of the solo 401k balance, not to exceed $50,000. As long as you pay that loan back pursuant to the payment schedule, we'll draw up the loan payment schedule and the loan note. They all have to be drawn up in accordance with the IRS regulations. The payment schedule will list the amount of payments due each month or quarterly. If you borrow for if you want to use the proceeds towards the purchase of a primary residence, then you can borrow for 15 or even 30 years. All other reasons for the loan, such as you want to borrow because you want to expand your business or for any other purpose, the maximum loan term is going to be 5 years. And we don't charge any additional fees for preparing the solo 401k plan loan documents. Now, if you want to borrow from your solo 401k plan, and actually, since we're talking about IRAs as well, that's one of the major differences between a solo 401k plan and an IRA is that the IRA regulations do not allow for loans, whereas you can borrow from your own solo 401k through a participant loan. So we find that many clients will transfer their IRA or even their self-directed IRA to the solo 401k, which also allows for investing in real estate so that they can take a loan from that solo 401k plan as well. So take a look at that link I just shared there regarding the solo 401k participant loan rules. And then as far as processing the loan, we can prepare those loan documents as soon as your account has been funded and those funds have cleared. Okay, now, if you're looking to borrow from your solo 401k plan and you're opening the solo 401k plan for the first time, or even if you already have one with us, it's going to be best to open up the brokerage accounts at Fidelity Investments for the solo 401k that we offer. So yes, even though Fidelity Investments offers their own solo 401k plan, which does not allow for participant loans. Fidelity Investments does provide what they refer to as non-prototype brokerage accounts for a self-directed solo 401k plan that does allow for solo 401k participant loans from a provider like my solo 401k financial, and we will assist you in opening the brokerage account at Fidelity in the name of the solo 401k, and also to transfer the IRA or former employer plan to that new brokerage account at Fidelity Investments for the self-directed solo 401k offered by my solo 401k financial that allows for solo 401k participant loans. The reason why you want to look into using Fidelity Investments for the brokerage account is because when it's time to make those loan payments, which again can be made monthly or quarterly, those need to go directly to the solo 401k holding account, aka brokerage account. With Fidelity Investments, unlike Charles Schwab, you're going to be able to link your personal bank account to that brokerage account for the solo 401k held at Fidelity so that you can make those payments electronically via ACH. You're going to link that brokerage account at Fidelity to your personal bank account because the loan payments have to be made with after-tax funds. That is, funds from your personal bank account. You cannot obviously use the solo 401k to make those loan payments because you borrowed from the solo 401k plan, nor can you use your business bank account. You have to use your personal checking account to make those loan payments because payments have to be made with funds from your personal bank account. Okay, hopefully that answers your question. Well, we've also come to the end of our session today. The good news is that we'll be going live. We're going to go live again here in a couple hours. We typically go live at least once a day, oftentimes twice a day, and today is one of those 2 a days. So, lastly, thank you for joining today's session. If you haven't yet, please like and subscribe to our YouTube channel, as it helps us get the word out to other solopreneurs like yourself and self-directed IRA account holders so that we can keep building this great community. It'll really help us if you like us on our YouTube channel, subscribe to it. You will also receive notifications regarding when we go live and deliver crucial content. Please also like us across the various social platforms. That's all for this morning. We'll be back again here in a couple hours. Until then, have a good rest of the day.